Welcome back to the channel, everyone. Today, we're diving deep into one of the most exciting and potentially transformative opportunities in the world of technology and investing, Fermi Inc. Fermi is a pre-revenue company whose near-term story is defined by numbers that quantify both the scale of its ambition and the magnitude of the execution gap it still must close. And the most recent quarter puts those figures into sharp relief. For Q3 2025, Fermi reported a net loss of $346.81 million, with basic and diluted earnings per share at $0.84, while cumulative losses for the first 9 months of 2025 reached $353.18 million, and EPS stood at $0.95. Revenue in the quarter was zero, which, although consistent with a company that has not yet entered commercial operations, nevertheless resulted in a miss versus analyst expectations of roughly $3.92 million and reinforces that the investment case today rests entirely on forward execution rather than current cash generation. Since the October listing, market capitalization has contracted from a little over $16 billion at the IPO to about $9.36 billion, a decline of approximately negative 39.75%, and the share price sits near 15.40, reflecting both dilution in investor enthusiasm and the market's reassessment of timing and risk across Fermi's development pipeline. Options positioning adds another quantitative lens to sentiment, with $15 strike price contracts trading around $1.35. The derivatives market is implicitly pricing additional downside probability relative to spot, a stance consistent with a speculative pre-revenue profile where outcome variance is high until capital projects convert into contracted power sales and cash flows. Put differently, today's valuation is a function of discounted expectations about future capacity, uptime, and pricing rather than a multiple on realized revenue or EBITDA. And the options premium indicates that investors require compensation for near-term uncertainty as the company advances through permitting, financing, procurement, and construction milestones. Against this backdrop, Fermi's operational arithmetic is centered on Project Matador, the planned 11-gigawatt private grid in Texas designed to supply highly redundant power at hyperscale for AI-centric data centers. Management has guided to bringing about 1.1 gigawatt of gas-fired capacity online by the end of 2026, with additional phases thereafter, and the company has executed a $150 million advance in aid of construction agreement and secured preliminary authorizations across clean natural gas and nuclear initiatives, all steps that, while not revenue generating in themselves, are necessary prerequisites to move from capital expenditure deployment to revenue origination. The outlook therefore hinges on three numeric pillars. First, schedule fidelity. Can Fermi convert engineering progress into commissioned megawatts on the publicized timeline? 1.1 gigawatt by end 2026 and staged ramps beyond, because delays directly extend the zero revenue period and increase cumulative losses. Second, contract conversion. Can Fermi translate capacity into contracted offtake with bankable counterparties at pricing that covers fixed charges, fuel, and O&M while delivering an adequate return on invested capital, since capacity without customers does not cure negative EPS? And third, financing scale and cost. Can the company secure the multi-billion-dollar project financing it will need at rates and covenants that preserve equity value, remembering that interest expense and debt service coverage ratios will be critical once assets are in service? On the external validation side, several sell-side firms have published supportive stances despite the current loss profile. Cantor Fitzgerald has assigned an overweight rating, and Macquarie also rates the shares overweight with a $35 price target, a level much closer to the initial IPO pricing, and implying that if Fermi meets its capacity and contracting milestones, investors could re-rate the equity toward a forward revenue and cash flow narrative rather than a construction stage story. The gap between today's $15.40 and those targets quantifies the execution premium the market requires, and it simultaneously frames the upside contingent on delivery. In the interim, however, the numbers argue for caution. With quarterly losses measured in hundreds of millions and no revenue, the company's burn implies continuing additions to accumulated deficit until assets begin producing and contracts begin billing. So any slippage in schedule would arithmetically extend the loss trajectory and pressure liquidity, while any shortfall in offtake or weaker than expected pricing would compress prospective margins and lower the present value of future cash flows. For prospective investors, that calculus translates into a risk-weighted waiting period. If one strategy prioritizes capital preservation and clearer risk-adjusted returns, the more defensible posture is to wait for initial megawatts to enter service and for the first meaningful revenue recognition, which management targets for 2026 as capacity comes online, and then reassess on observable evidence rather than assumptions. If early revenue in 2026 and 2027 demonstrates adequate capacity factors, uptime, and pricing, and if the company discloses contracted backlog with creditworthy customers at tariffs that support positive unit economics, the equity case could shift from speculative to more measurable, with EPS moving toward break-even and then into positive territory as fixed costs are absorbed and scale benefits accrue. If this scenario occurs, we could see this stock double or even triple as we move into 2027, which could lead to a 200% profit. Until that inflection, the quantitative signposts to monitor are clear. Quarterly loss magnitude, does it stabilize or widen as CapEx ramps? Cash and equivalents, does the balance sustain the schedule without dilutive equity raises? Debt financing progress, do announced facilities match the CapEx cadence and at what blended cost? Contracted capacity, how many megawatts are under firm agreements and at what average price? And commissioning progress against the 1.1 gigawatt 2026 target. Is the milestone track intact? Because meeting it is the first data point that can begin converting the options market's price downside into realized execution. The share price path since IPO, down roughly 40%, with market cap near $9.36 billion, already embeds substantial skepticism about near-term catalysts. And the $15 strike options trading near $1.35 indicate hedgers continue to pay for protection against further declines. To reverse that, the company must deliver tangible, time-stamped progress that narrows uncertainty around the three numeric pillars and shifts investor models from scenario analysis to cash flow forecasting. In summary, the current numbers say Fermi is a large, unprofitable, pre-revenue developer with a shrinking market cap and a stock around $15.40, with analysts split between long-term optimism, overweight ratings, and a $35 target, and near-term caution, options pricing that implies downside risk, and the outlook says the transition to revenue depends on hitting the 1.1 gigawatt 2026 commissioning milestone, scaling capacity thereafter, and proving that contracted pricing and uptime can translate gigawatts into dollars. For investors whose mandate tolerates elevated execution risk, The asymmetric payoff is conditioned on those milestones, while for those seeking clearer visibility, the prudent approach is to revisit the equity once initial revenue is recognized and the quarterly numbers begin to reflect operations rather than construction, at which point loss magnitudes should shrink. EPS should begin to improve, and valuation should anchor to forward EBITDA and cash generation rather than hope, delivering a more defensible basis for allocating capital. Thanks for tuning in. Let us know what you think of Fermi and the outlook for speculative power companies in the comments below. Don't forget to like, subscribe, and hit the bell for more deep dives into the technologies shaping our future. Until next time, keep questioning, keep learning, and keep investing for tomorrow.